When I first learned this game, I thought the market was talking to me all the time. Every tick felt like a message. Every small move looked important. That was my first mistake, and maybe it's yours too. The market isn't always speaking. Most of the time it's just clearing its throat. Short-term noise is the chatter of a crowd, not the voice of the tape. And if you listen to every whisper, you'll never hear the truth. You see, price moves for two reasons: real pressure and meaningless motion. The trouble is, both look the same to an untrained eye. A little rally here, a sharp dip there, and suddenly you feel clever or foolish, based on a few minutes of action. Haven't you felt that pull before? That urge to act just because something is happening? That's not trading. That's reacting. And reaction is expensive. The market is designed to fool the most people, most of the time. That's not cruelty, it's mechanics. Short-term noise exists because different players have different motives. The small speculator wants excitement. The professional wants position. The operator wants liquidity. When all those motives collide on a short time frame, you get movement without meaning. If you don't know the difference, the market will teach you, by taking your money. I learned early that the tape does not reward activity, it rewards patience. Yet patience is hardest precisely when prices are moving fast. When bars start printing quickly and your screen lights up, doesn't your pulse rise with it? You tell yourself you're staying alert, but really you're becoming emotional. Noise feeds emotion, and emotion feeds bad trades. The greatest losses I ever took didn't come from being wrong about the main trend. They came from letting short-term fluctuations shake me out of a sound position or lure me into a foolish one. I'd sell because the market dipped a little, only to watch it resume its march without me. Or I'd buy because of a sudden pop, only to realize later it was nothing more than nervous covering. Have you noticed how often the market reverses right after it makes you feel certain? Noise works because it feels urgent. It tells you, do something now or miss out. But real opportunities don't shout. They wait. A true move builds quietly, with time doing most of the work. If you must be coaxed or frightened into a trade, the trade is probably born of noise. A man who understands charts understands context. He knows that a 5-minute move inside a weekly structure means very little. He knows that volume without follow-through is a confession of weakness, not strength. Yet how many traders stare at the smallest time frame and call it analysis? Isn't that like judging the ocean by a ripple at your feet? Short-term noise preys on the trader's need to feel smart. You catch a quick move, make a little money, and suddenly you believe you've unlocked something. Then the market changes its tone and takes it all back, plus interest. The tape has a way of humbling anyone who confuses luck with skill. I've never known a trader who survived long by chasing every wiggle. Money mindset matters here more than people admit. If you believe your job is to trade often, you will be enslaved by noise. If you believe your job is to trade well, you will learn to sit still. The market pays for judgment, not for motion. Ask yourself, honestly, are you trading because there's an edge, or because you're uncomfortable doing nothing? Charts are not predictions, they are records of behavior. Short-term noise is simply behavior without commitment. Prices move, but they don't go anywhere. The range tightens, breaks, snaps back, and leaves a trail of confused traders behind. Meanwhile, the larger forces are still building positions quietly, waiting for the moment when movement turns into direction. I always said the big money is made by sitting, not by trading. That's easy to quote and hard to live. Sitting means watching noise pass by without touching it. It means trusting your preparation more than your impulses. When a market chops sideways and your account balance doesn't change, can you accept that as success? Most can't, and that's why noise keeps winning. Short-term charts magnify fear and greed. A small loss looks like a disaster. A small gain feels like proof, but neither one matters unless it fits the larger picture. Wealth in trading is built the same way trends are built, gradually, with discipline, and with many hours of waiting between decisive actions. Anyone who tells you otherwise is selling excitement, not results. There's a dangerous idea floating around that faster is better. Faster data, faster trades, faster profits. But speed only helps if you already know where you're going. Otherwise, it just helps you get lost more quickly. The market doesn't care how fast your platform is. It cares whether you understand what phase it's in. Accumulation, markup, distribution, decline. Noise lives in between these phases, feeding on uncertainty. Let me ask you this, if noise were profitable, wouldn't the calm traders be broke and the frantic ones be rich? Look around. The traders who last are quiet, almost boring. They wait for confirmation. They size properly. They ignore most of what happens during the day. Their charts are clean because their minds are clean. Short-term noise will always be there. You can't remove it from the market, and you can't outsmart it by being clever. The only defense is perspective. Know your time frame. Know why you're in a trade. Know what would actually prove you wrong. If a small fluctuation can knock you out, your position was never strong to begin with. Noise exists to provoke action, not opportunity. That truth took me longer to learn than any chart pattern or rule about position size. The market does not move to help you. It moves to test you. Every flicker in price is not an invitation. Most of them are traps laid by time, randomness, and human impatience. The market knows one thing about the average trader. He feels uncomfortable when nothing happens. Noise is designed to keep him busy. Action feels responsible. Doing something feels like control. Sitting still feels like negligence. That is exactly why noise works. When prices twitch back and forth, the trader starts narrating a story in his head. He imagines causes, intentions, hidden forces. He assigns meaning where none exists. Have you noticed how convincing those stories sound in the moment? That's because the mind hates silence even more than loss. Opportunity does not need to hurry you. It does not flash or shake you by the collar. Real opportunity waits until pressure has built and direction is clear. Noise, on the other hand, thrives in uncertainty. It thrives in narrow ranges, sudden spikes, and sharp pullbacks that go nowhere. It pretends to be urgency. It says, act now. But if you step back and look, nothing has actually changed. The market uses noise the way a poker table uses chatter. It keeps weak hands involved. It keeps players guessing. If price moved only when it truly mattered, trading would be simple. But simplicity does not shake people out of their money. Complexity does. Noise creates the illusion of constant choice, and with it, constant error. Every trader must decide whether he is paid for action or for judgment. The market pays only one of those. Judgment requires waiting, and waiting is uncomfortable. When noise dominates the tape, the trader feels useless. He thinks, I should be doing something. That thought alone has emptied more accounts than bad analysis ever did. Noise also flatters the ego. You catch a small move, exit quickly, and tell yourself you were sharp. The market lets you feel clever just long enough to build confidence without foundation. Then it changes rhythm and punishes the habit it encouraged. Isn't it strange how the market rewards you just enough to keep you coming back? Opportunity is selective. Noise is generous. Noise offers 10 trades a day. Opportunity may offer one a week. That difference matters more than any indicator. A trader who cannot tell them apart will always feel busy and always feel broke. He will say the market is hard, when in truth he is listening to the wrong voice. I learned to ask a simple question before acting. If I do nothing here, what happens? Most of the time, the answer was nothing. Price would wander, retrace, and erase the entire move that had felt so important minutes earlier. Noise collapses when observed over time. Opportunity strengthens. Time exposes intent. Short-term movement often exists to create discomfort. It shakes loose weak positions and tempts early entries. It punishes patience by making it feel foolish. Have you ever watched a market drift just enough to stop you out, only to move cleanly afterward? That is noise doing its job. The trader who survives understands that the market does not reward vigilance, it rewards restraint. Watching every tick does not make you informed. It makes you reactive. Reaction is what noise wants. Noise feeds on quick decisions made to relieve emotional pressure rather than to exploit an edge. There is also a money lesson here. Wealth is built by aligning capital with direction, not by churning it through indecision. Noise encourages churn. It makes you feel involved while quietly draining commissions, spreads, and confidence. Opportunity asks for commitment and offers return. Noise asks for attention and offers nothing. The hardest discipline is to ignore what looks important, but is not. Charts are full of meaningless movement. The professional filters it out. The amateur leans closer. One sees signal emerging. The other sees constant invitation. Which one do you think the market prefers? Noise will never disappear. Markets are made of people, and people are emotional. The goal is not to eliminate noise, but to stop obeying it. When you stop answering every call, the important ones become obvious. Until then, every ring sounds urgent. The market does not punish ignorance as harshly as it punishes impatience. A man can be wrong and still survive if he is disciplined. But a man who acts on noise will eventually be right and still go broke. Noise turns time against you by speeding up your decisions and slowing down your learning. If you feel compelled to act, ask whether that compulsion comes from the chart or from discomfort. Opportunity does not create restlessness. Noise does. One aligns with preparation, the other with impulse. Most traders lose not because they miss opportunity, but because they obey noise. Short time frames magnify emotion, not truth. I learned that lesson the hard way, staring at charts so small they showed every twitch of fear and greed the market could produce. The closer you press your face to the screen, the louder the noise becomes. Every tick feels personal. Every pause feels threatening. And every small gain or loss feels like proof of something larger than it really is. A short time frame does not reveal more information, it reveals more reaction. It shows you how traders feel minute by minute, not what the market is actually doing. Fear shows up as sudden drops. Greed shows up as sharp pops. Indecision shows up as endless back and forth. The problem is that emotion changes faster than structure. Truth moves slowly. Emotion sprints. When you watch a 1-minute chart, you are not watching a trend form. You are watching hesitation. You are watching traders guess themselves in real time. Have you noticed how convincing those tiny moves feel while you're watching them? That's because emotion is contagious. The chart doesn't just show emotion, it transfers it. Short time frames make small things feel big. A minor pullback feels like the start of a collapse. A modest breakout feels like the beginning of a fortune. Perspective disappears. The trader stops asking where price is going and starts asking where price is right now. That shift alone is enough to ruin judgment. Truth in the market lives in context. It lives in structure, in trend, in accumulation and distribution over time. Short time frames strip that context away. They reduce a complex process into a stream of impulses. You wouldn't judge a business by its hourly cash register receipts, yet traders judge markets by 5-minute candles and call it analysis. Emotion loves immediacy. It wants answers now. It wants confirmation now. Short time frames feed that hunger. They keep the trader emotionally engaged, which feels productive but isn't. The more emotionally engaged you are, the less objective you become. And objectivity is the only edge a trader ever really has. I've seen traders abandon sound positions because a small bar went against them. Nothing in the larger picture changed. Supply and demand were still aligned. The trend was still intact. But emotion, magnified by a short time frame, convinced them something was wrong. Have you ever exited a trade and felt relief, only to watch price move exactly as you originally expected? Short time frames also inflate confidence. A trader catches a few quick moves and believes he has cracked the code. He feels sharp, responsive, in tune with the market. But what he's really doing is sensing his emotions with the market's mood swings. That works only as long as the mood stays familiar. When it changes, losses come fast and without warning. Truth does not flicker. It persists. A genuine trend absorbs pullbacks. It survives hesitation. It does not depend on perfect timing to remain valid. But short time frames demand perfection. They punish being early, punish being patient, and punish being human. They reward reflexes, not reasoning. The market already has enough emotion without you adding yours to it. Short time frames invite you to participate emotionally rather than strategically. They make you feel responsible for every move you miss and every tick you endure. Over time, that pressure erodes discipline. The trader starts trading to feel better, not to make money. There is also a subtle money lesson here. Wealth grows by aligning with forces larger than yourself. Short time frames focus you on forces smaller than your own emotions. They encourage small wins and frequent losses, which feels like progress, but often isn't. Truth compounds. Emotion churns. The longer the time frame, the quieter the noise. Not because nothing happens, but because what happens matters. Large players do not build positions in minutes. They build them over days and weeks. Their footprints do not show clearly on short charts. All you see there is the scrambling of smaller traders reacting to one another. Short time frames can make you feel informed while leaving you blind. You see more, but you understand less. You know every fluctuation but miss the direction. It's like reading every word in a book without understanding the story. The market is a story told over time, not a series of disconnected sentences. Ask yourself honestly, does watching faster make you calmer or more tense? Does it improve your decisions or shorten your fuse? The answer tells you whether you're seeing truth or just feeling emotion amplified. The market does not hide truth. It reveals it slowly. Impatience is what obscures it. Short time frames reward impatience by making it feel engaged and alert. But alert is not the same as right. A trader who wants truth must learn to step back. He must accept that not knowing every small move is a strength, not a weakness. He must allow time to filter emotion out of price, leaving only direction. Most mistakes are not analytical. They are emotional decisions made under magnification. Short time frames act like a lens that enlarges fear and greed until they look like facts. Once you mistake emotion for information, the market has you exactly where it wants you. Real trends whisper while noise shouts. I learned that lesson by losing money to the loudest moves on the screen. The market has a way of drawing your attention to what does not matter and hiding what does. The sharp spike, the sudden drop, the wide bar with no follow-through. Those are the shouts. They demand attention. They stir emotion. They make you feel late, wrong, or foolish. And almost always they fade. A real trend does not announce itself. It does not kick the door open and beg to be chased. It develops quietly, often when nobody is excited. The early stages feel dull. Price moves steadily, sometimes unevenly, but with purpose. There is no drama in it, which is why most traders miss it. Have you noticed how boredom often shows up right before something meaningful begins? Noise relies on urgency. It creates the sense that if you do not act now, you will miss everything. Real trends do not require that kind of haste. They allow time for mistakes, pullbacks, and second chances. If a move disappears the moment you hesitate, it was never meant to carry weight. The market does not build fortunes on moments that vanish in seconds. The shouting moves are emotional moves. They are driven by fear, short covering, rumors, and impatience. They expand quickly and collapse just as fast. They look powerful but lack depth. A whispering trend, by contrast, is supported by steady buying or selling over time. It advances, pauses, absorbs selling or buying pressure, and continues. It is not impressive to watch in real time. It only becomes obvious in hindsight. Most traders are trained, without realizing it, to chase noise. They wait for excitement as confirmation. They want proof in the form of speed and size. But the market's most important work is done quietly. Large interests do not shout. They accumulate patiently. They distribute carefully. Their footprints are subtle, and subtlety requires attention, not excitement. Noise flatters the trader's ego. It says, "You're early. You're sharp. You caught it." A whispering trend offers no such praise. It tests your conviction by moving slowly and sometimes painfully. It asks you to hold through doubt. It asks you to trust structure over sensation. Isn't it easier to feel right in a noisy move than to be right in a quiet one? Real trends are built on agreement. Price, volume, and time begin to align. Pullbacks hold higher levels. Rallies extend a little further each time. Nothing dramatic happens in any single moment. The significance comes from repetition. Noise has no memory. It spikes and forgets itself. I've watched traders ignore a steady advance because it looked too easy, too slow, too obvious. Then they jump into a sudden breakout that feels exciting, only to be trapped when it fails. The market does not reward excitement. It rewards alignment. The whisper carries more truth than the shout because it lasts. There is a mindset lesson here that reaches beyond charts. Wealth is built quietly. It compounds while nobody is paying attention. The loud moves, sudden wins, fast profits, rarely change a trader's life. They change his emotions. The steady gains, repeated over time, change his account. Noise feeds stories. Trends build results. When you listen too closely to the shouts, you lose sensitivity to the whispers. Your threshold for action rises. You need more movement to feel justified. Soon, only extreme moves get your attention, and by then, you are late. The trader who survives learns to lower his volume, not raise it. Real trends often begin when the news is quiet or even negative. They grow while opinions are divided. By the time everyone agrees, the move is mature. Noise, on the other hand, thrives on consensus in the moment. Everyone sees the same thing and reacts at once. That reaction creates movement, not direction. Ask yourself what kind of move you are drawn to. The one that makes your heart race, or the one that barely gets noticed. Your answer will tell you whether you are trading emotion or structure. The market is always offering both. You only get paid for choosing the right one. A whispering trend allows you to manage risk. You can enter, add, reduce, and sit. A shouting move forces decisions under pressure. It demands instant perfection. One mistake and you are punished. The market is generous to patience and ruthless to haste. The trader who understands this stops asking, "What just happened?" and starts asking, "What is developing?" He shifts from reacting to observing. He lets the noise pass and watches for consistency. Over time, the whispers become clearer, and the shouts lose their power. Impatience is the market's favorite accomplice. I don't say that lightly. I say it because I've watched impatience do the market's work better than any operator ever could. The market doesn't need to trick you if it can hurry you. A hurried mind supplies its own mistakes, and the market is always willing to take advantage of that. Most traders believe their enemy is being wrong. It isn't. A man can be wrong and still survive if he waits for the right moment to act. The real enemy is the feeling that you must act now. That feeling is impatience wearing a sensible disguise. It whispers that time is slipping away, that opportunity is passing, that inactivity is failure. Have you noticed how convincing that voice sounds when prices are moving but going nowhere? Impatience shows up long before the trade. It shows up in analysis. A trader scans charts and wants an answer immediately. He doesn't want to wait for confirmation. He wants certainty now. When he doesn't get it, he lowers his standards. He starts calling setups good enough. The market doesn't punish him for this right away. It lets him in. Then it waits. Nothing helps the market more than a trader who cannot sit still. The impatient trader trades because time feels heavy. He wants relief. He wants resolution. He wants the discomfort of waiting to end. So he clicks the button. The trade becomes a way to escape uncertainty rather than a way to exploit an edge. I've seen traders enter positions not because the chart demanded it, but because they were tired of watching. They'd say, "It has to move soon." That sentence alone tells you whose side they're on. The market does not move to satisfy your schedule. When you impose time on price, price punishes you. Impatience also ruins exits. A trader takes a small profit because he's afraid it will disappear. He cuts a winner short and tells himself he was disciplined. Then he lets a loser run because he can't accept being wrong. Both decisions come from the same place, wanting the feeling to be over. The market feeds on that imbalance. The market loves impatience because it accelerates errors. It turns small mistakes into repeated ones. A patient trader may take one bad trade and stop. An impatient trader takes 10, not because he's ignorant, but because he's restless. He confuses motion with progress. Short-term noise thrives on impatience. It gives the impatient trader something to react to. A flicker, a spike, a pullback. It doesn't matter. It's movement, and movement feels like opportunity to a restless mind. The market doesn't have to create direction. It only has to create activity. There is a false belief that good traders are fast. They are not. They are deliberate. Speed comes only after clarity, not before it. Impatience reverses that order. It demands speed in place of understanding. The trader acts first and explains later. The market accepts his money without explanation. Impatience often disguises itself as ambition. The trader says he wants to grow faster, learn faster, make more. But ambition without discipline is just hurry. Wealth does not respond to hurry. It responds to consistency. You cannot rush compounding. You can only interrupt it. I've noticed that impatience grows strongest after periods of nothing happening. A trader watches a market drift sideways for days. He feels ignored. He feels excluded. When price finally moves a little, he jumps. Not because the move is meaningful, but because he's been waiting too long. The market uses boredom the same way it uses fear. Ask yourself how often you enter a trade just to feel involved again. The market doesn't care whether you're involved. It cares whether you're aligned. Impatience pushes you into trades that have no reason beyond relieving tension. The patient trader accepts uncertainty as part of the cost. He knows waiting is not wasted time. It is preparation. The impatient trader treats waiting as an obstacle. He resents it. That resentment leaks into his decisions. He forces trades the way a tired man forces conversation. Impatience also shrinks perspective. When you want something now, you stop seeing the larger structure. You focus on the next bar, the next tick. The future collapses into the present moment. That's exactly where the market wants you, trading the smallest picture with the largest emotions. The market does not reward urgency. It rewards alignment. Alignment takes time to recognize and even more time to trust. Impatience erodes trust. It makes you abandon good ideas before they have time to work and embrace bad ones because they move quickly. Every trader pays for impatience. The only question is how often. Some learn early and slow down. Others keep paying, thinking the problem is the market, the method, the instrument. Rarely do they suspect the problem is the need to hurry. The market will always offer you something to do. It is generous that way. Your job is to decide when doing nothing is the correct action. That decision separates the trader who survives from the trader who stays busy.